Hey guys, good morning. It's Saturday morning. Sean Bucci here. I want to give you guys a little more information about some special debt. Let's call it special debts when you're dealing with real estate and even with surplus funds, because when you're looking at surplus funds or overages from tax or mortgage foreclosure, if the debt was in place prior to the sale, that debt has a priority claim to the surplus in front of the owner. I've said this again and again. Everybody thinks everything gets kicked out by the foreclosure or tax deed sale, and you're right, it's kicked out against the property if whatever's foreclosing had a priority, was in first position as far as debt against the property. It kicks everything behind it out, but it doesn't kick it out against the surplus or the overage. And a lot of people misunderstand that, and they go after property, or rather surplus funds, and I'm going to talk about deed flipping too here, flipping property, but they go after surplus funds with the idea that they don't have to do title work because the owner's entitled to the money regardless of whether or not there was debt, and that's just not true. But there's certain kind of debt that is weird or odd, and you guys need to know about it. One of them is IRS tax liens, and I'm going to address this from both the overage standpoint and flipping property. First of all, if there was an IRS tax lien against that individual prior to the sale, okay, that tax lien has a priority, the federal tax lien has a priority, this IRS has a priority lien technically in front of everybody, okay? So here's what you need to consider with that. When you're flipping property, that IRS tax lien, this stuff you see online about, oh, the IRS is ready to make a deal and they're ready to do this and they're ready to do that. I'm going to speak completely from my experience, which is pretty extensive in this, and that is, they don't even talk to you. They're not going to talk about giving you a deal or writing off a portion of it or any of that. If they had an IRS tax lien against that individual prior to the sale, or if they have it now, if you're about trying to buy a property, that tax lien falls off when it falls off. Period. And they're not gonna cut. My experience, they're not gonna cut deals with you. Now, here's where it gets crazy with the IRS tax liens, and that is in the overage arena. Okay. Technically, the flipping too, but not necessarily. It's too rare to really even think about that. So, let's talk about overage recovery and IRS tax liens. Well, what I've said before is that unless that debt was in place prior to the foreclosure against the individual, it doesn't count against the property. IRS tax liens are different, okay? Let's say that a property sells January 1st at a mortgage foreclosure, and it generates, there's $50,000 in overage there. There's no debt against the property or the person at the time of the sale, and there's $50,000 left over because somebody paid $50,000 more than the debt there was against the property. Happens all the time. Let's say an IRS tax lien comes in January the 15th. Well, the easy thing to do is think, hey, that IRS tax lien came in January 15th, it doesn't apply against the overage. Well, here's the problem. The IRS is above the law. So even though their judgment, their lien, didn't get put into force until January the 15th, they're the only creditor on the planet that can actually say, you know what, this is from an older debt, in this case, third quarter of 2017 is when this was generated. So the IRS gets the value of, usually it's 10 years, it stays in place, IRS tax lien. They get the value of that, plus that's from when it's recorded, when the judgment or lien's recorded. So January 15th for 10 years. Plus, because it's from, let's say, a year and a half ago of taxes, they actually take a priority position during that year and a half prior to that. Okay? Now that's screwy, because anybody else looking to make credit cards or whatever, and they don't know about that IRS tax lien, if a bank is going to give them a credit card, they don't know about this, and the IRS can actually come in and be in front of them as far as wanting to collect stuff, bankruptcy, in a bankruptcy situation or anything like that in particular. So you got to be careful with the IRS tax liens. that's with overages. With deed flipping, if you buy that property and record it before or flipping property, you buy that property, record the deed prior to that lien being recorded, it doesn't work that way. They won't look past that. That's the first thing, the IRS tax lien. Second thing I want to cover is code enforcement liens. Code enforcement liens, in most cases, have an initial judgment amount and then penalties. It can be an interest penalty for non-payment over time, or it can be more than that. It can be a certain amount of money for every 30 days you're late, whatever. In most states, that code enforcement lien has a cap. Makes sense, right? Look, there's a code enforcement lien. You didn't cut your yard. They went and cut the yard. They took out a lien for $150 to cut the yard, to cut the grass, and then they're saying, look, for every for every month you don't pay, it's $50 more a month. Okay. In most places, there's a cap where you can actually approach them and go, hey, you got a code enforcement lien here. It was initially for $150. It's been on there for a year or 3 years, let's say, right? So it's $50 a month that's 600 times 3, 1,800. Come on, guys, you're really not going to charge me $1,800 plus the $150 to pay off this lien, right? And a lot of the areas don't. They go, no, you're right. We're going to charge you $300 instead of $1,950 to pay off this code enforcement lien. Florida is the exception to the rule, depending on where you are. The further south you go, it's just a weird thing. The further south you go in Florida, the more likely they are to keep that thing on there forever. Literally, we have seen someone, I kid you not, owe tens of thousands of dollars in penalties alone on a $150 grass cut in a southern Florida county. And the county wasn't willing to back off. They said, this is what we're owed, this is what we're going to get. And code enforcement liens are, in most states, similar to tax liens in that they don't go away. They don't get kicked out by the foreclosure. Anything like that. So you need to be really careful of that. Double check for code enforcement liens, of course, when you're checking debt. Another one you need to be careful of is take a minute and Google, when you're online, Google super lien states. Now, what those are is super lien states say that HOA debt actually has a priority claim in front of everybody except for the tax man, except for county taxes. The way that works in reality, more and more states are coming out of the super lien. They're saying, screw you, we're not doing this priority lien thing automatic unless the HOA has a recorded judgment. It doesn't count. They don't get to come in and go, hey, the guy owes me $1,800. I know we didn't have a lien against him or a judgment against him, but that's what they owe. Some states are not like that. When you're working in a super lien state, and there are lists of super lien states, when you're working in a super lien state, be very careful and double check what the HOA was owed. I'd call them. Was there anything owed against this property if you're about to buy it, where it's going to foreclosure, or if there was an overage against it? Either one. You need to be careful and double check that. Okay? Because they can have, in certain states, the super lien states, they can still have a priority claim, and you need to be very, very careful of that. Now, those guys are more apt to negotiate. Usually they have an attorney that they use on retainer, and you can call that attorney and go, look, they owe $12,000. I'm trying to put a deal. I'm always honest about it. Hey, I'm trying to put a deal together with the owner, but with the $12,000, I don't have the profit margin I need. I'd like to at least pay you something. So, and they're going to win too. They don't have to take anybody to court or anything like that. I'd like to pay you something, obviously, to make you guys happy, but I need to make my profit. How about $5,000? And usually I end up paying about 60 to 70% for HOA liens, for unpaid HOA dues and penalties and things like that. And I'm happy with that. Sometimes you can do a little bit better, but most of the guys are willing to talk to you, which is good. The last type of judgment I want to talk about is actually a defendable judgment. And what I mean by that is, let's say you buy a property and there was a judgment against the person, but it wasn't wasn't recorded in the same county as where the person lived. Well, as a result, it doesn't count where the property was. It doesn't count against that property for title. Okay, it's recorded in some other county. They're not even going to look up what debts are recorded in other counties or other states. They're looking at what's recorded in the county where the house is. Okay, so having said that, what you run into is people do what's called transcribing a judgment or a foreign judgment. So, for instance, Mecklenburg County is next to me, Mecklenburg County, North Carolina. Everything's cool, things are going great. I bought the property. What I've seen before is someone from a surrounding county, or somebody had a judgment against that individual in a surrounding county, Catawba County, whatever. They transcribed that judgment. It's a foreign judgment. They got Mecklenburg County to accept it. And it's not easy to get these counties to accept judgments recorded in other counties, but they got it done. Then they came and said, hey, look, the judgment was initially recorded a year before you bought the property in Catawba County. We just recorded it, and yes, you've already bought the property, and it was against the previous owner, but we think we have a right to it because it was recorded in Catawba County 2 years ago. Okay? That's defensible. Your attorney should be able to shoot that down. Okay? They can't let that happen, because then people would never be able to get completely free title without doing judgment searches in every county everywhere. So that's one you can actually shoot down. Foreign judgments, transcribed judgments can be, and we have shot those down. So that's another one to consider. I know this stuff sounds scary and all that. As long as you do your homework and you're careful, you're fine. My last bit of advice is, we use quick claim deeds. We don't use assignable contracts because we're paying them very quickly. But we use quick claim deeds to get the deed over to our name. And then we record that, pay off the debt, and we own it. Now we flip it. And there's no issue with that. Here's where the issue comes up. If the owner prior to you, that you bought it from, bought it using a quick claim deed, quick claim deeds don't address debt. They're just here's the house. I'm not telling you if I owe anything. If I do, tough. I'm just selling the house to you. That's what a deed is, transfer of ownership. If the guy you're buying it from bought it with a quick claim deed from somebody else, you need to go back to the person they bought it from and check to see if there was any debt against the property or that person at that time, because that can roll forward. Okay? Quick claim deeds work fine. It's not going to screw up your title, but it's going to require the title company search the owner prior to that quick claim deed and search debt against them as well that was against the property at that time. Hope this helps. Have a great weekend.